In this video, we want to talk about JPMorgan Chase, and they were another bank that kicked off the earnings season this past Friday when they reported earnings that topped estimates for profits and revenue on better than expected interest income, even amid expectations that interest rates are going to continue to decline. Now, this is the monthly chart, and I do want to bring some levels of interest to your attention. This is a monthly buy level. We'll call it at 170. So that is monthly buy. And the way that level was formed was we had this rally in price, one basing candle, and then the rally out. And that rally out takes out what was the previous all-time highs. As you can see, price pulled back, but couldn't quite get to that level, indicating that there are buyers waiting to fill their unfilled orders. Nevertheless, price continued to rise and almost took out all-time highs on Friday. But according to the daily chart, you had some profit taking towards the end of the day. Zooming out to the weekly chart, I like this other level here. You have this rally base rally. Depending on your stop level, that level would have worked or would not have worked. You have another rally, base rally, takes out the pivot high to the left. And if you had your stop below near that 188 level, that was good for at least a 4-to-1 reward to risk ratio. Let's zoom down to the daily chart. And you can see on the announcement on Friday, you had this gap and go. Again, nearly taking out all-time highs near that $225 level. Now let's look at this video to get into the details on the actual results from JP Morgan.
Just weeks ago, they guided that the street was too optimistic for next year, but this year still looks good. However, the provision for credit losses also came in higher than expected. So here come the questions about credit quality. The quarter included $1 billion reserve build as well. So we'll have a lot of questions about that outlook. Remember, Jamie Dimon has been kind of warning about skepticism over a soft landing, worries about next year. But then you also have investment banking coming in higher than expected as well. Of course, JPMorgan, a behemoth in every major business line in investment banking. So that is a positive, especially because typically you don't get those deal fees until those deals close. So the fact that it looks this good right now is pretty positive.
Stock is up by 0.1%. This is always the case with JP Morgan numbers. The numbers drop. You've got to look at them, and then you've got to chase the squirrel that Jamie Dimon starts talking about. Large fiscal deficits are a critical issue. We'll get to the squirrel in just a moment. Lisa, let's start with the numbers themselves.
Yeah, what's interesting to me is that it's sort of the opposite story than what a lot of people expected. Net interest income actually came in better than expected. We also saw this pretty much in other areas as well, like BlackRock. However, the provisions for credit losses ticked up. And to me, the idea that it's the exact opposite problem. It's actually that Ally Financial, on the margins, was setting the tone maybe in a better direction or a worse direction, but a more accurate direction than some of the net interest income issues.
This is where things were set up coming into this. It was Ally Financial 1. It was the words of Dan Pinto 2. The words of Mr. Solomon over at Goldman Sachs as well, 3. They'd all set the bar that much lower going into this report.
Well, remember also, JP Morgan heading into this report is trading at almost 2 times its book value, right? We're seeing pretty record levels of where its stock has been trading. And in addition to that, something to consider, and this is why they're setting expectations so firmly here, the returns on tangible common equity coming in at 19% is well over what was expected. It was 28% last quarter. And so this normalization and what you're seeing in profitability of the banks is pretty interesting, especially considering JP Morgan is the behemoth. There's one more point I'd want to make on this. JP Morgan Fascinating analysis by Morgan Stanley. A lot of their loans are floating rate. So as rates drop and as the interest rate picture changes, they're actually net, according to Morgan Stanley, a negative here, because they would have a negative impact from those floating rate loans. When you see those provisions for loan losses starting to build, you start to ask more about those credit card books. We didn't ask about that a whole lot over the last couple of years, but people are maxed out on credit across the entire country. How fast does that turn?
You know, I have to wonder what's signal and what's noise. With credit build, that's partly also the executive management and how they're looking at potential risks down the pike, as much as it is about current risks that are building. And so I do wonder if you pair JPMorgan with Wells Fargo, for example, where provisions for credit losses were below expectations at $1.07 billion versus the estimate of $1.34 billion, but they missed a net interest income. This is a motley picture that has to come down to execution and risk management expectation going forward.
Well, what's the cost of that net interest income, right? Risk. And so when you see them take those provisions, it's at the benefit of that higher net interest income, but then, you have to make that income. You can't lose too much money on it. For Wells Fargo, they don't have that credit card book that JPMorgan has, right? That behemoth credit card book. By the way, Sapphire Reserve, right? A lot of these customers are not low-income, middle-income customers who have been struggling through this environment. They tend to be wealthier customers.